The WS Blue Whale Growth Fund is a concentrated, long-only global equity fund which typically holds between 25 and 35 stocks at any one time, with a focus on large-cap companies in developed markets. Returns over the last year are up almost 42%. Blue Whale was set up by lead fund manager Stephen Yu, our man here tonight, and backed by Chairman Peter Hargreaves. Here to discuss the portfolio and to give us his view of current investment trends, such as AI, is Stephen Yu. Welcome, Stephen.
Hi, good evening, everyone. Thank you for joining us. So today I would probably just want to run through the positioning of the portfolio, and I have got a slide for that to share. But if you haven't followed us, one thing that has been quite interesting throughout the course of the last 7 years when we started back in 2017 is the investment philosophy is very simple, that we aim to invest into high quality businesses at an attractive price. But what has been slightly different in terms of the position I'm going to take you through today is the opportunity set has evolved over the last 7 years. And of course, when we first started back then, it was pre-pandemic. We were heavily exposed to companies that are exposed to digital transformations. And digital transformation was a big theme at the time. And of course, then we ended up doing quite well during the pandemic in 2021 as well, 2020 and 2021 as well. And digital transformation at the time would encompass e-commerce, digital advertising, digital payments, software, cloud, and some others. And that's just like a very big theme in that period. But then in 2022, we recognized that we are in a new regime, which is a new regime that I'm going to take you through more in the next 10 minutes or so. And of course, then we have acknowledged that certain names that we used to own before is no longer the place to be. At the same time, we also ended up investing into some new names or positioning that we think is going to benefit under this new regime. So what you see on page 2, which is the how the fund is positioned today, I broke it down into 3 different buckets. One is what we call the transcendent companies, which would be companies that are exposed to artificial intelligence, and that would be kind of the similar way of investing into companies back before the pandemic that we think could transcend macro uncertainties. So these companies today would be names that are exposed to artificial intelligence, which I'll come back onto later. And of course, 7 years ago, it was a lot more to do with digital transformations, which I just mentioned earlier. But of course, just talk about in 2022, we recognize that we are in a new regime. What is this new regime? It's a combination of continuation of geopolitical uncertainties on the back of the Ukraine conflict, and we have seen a lot more over the last 18 months or so. At the same time, inflation to be quite sticky, and then at the same time, also the oil price, energy prices is going to remain quite high on the back of geopolitical uncertainties. And of course, when you put all these things together, what it means is interest rates going to stay higher for longer. And of course, a lot of people or investors are hoping that interest rates are going to get cut in the next year or so, which obviously I think where we are today, the interest rate is probably higher than what it needs to be given the level of inflation that we're experiencing. But what investor might be missing currently is the magnitude of the cuts or reduction that we will see in the coming years. So just a reference point, if you look at the US interest rate regime, the expected rate reduction, including that over the next 5 years, so between now and 2029, which is a long time from now, the average interest rate in the US expected is about 4%. So if you think about like in the next 5 years, the US interest rate is going to average at a rate of 4%. That's very high level compared to what we experienced before the pandemic, for the 10 years running in the pandemic. So then it does have implications in terms of what you want to invest into or companies or sectors that you want to avoid under this new regime. So what I've got in this second bucket, which we call them the new regime beneficiaries, are companies that would actually benefit from some of these uncertainties. And if you haven't followed the fund closely, in Q4 2022, we decided to invest into our first and only energy company, which is called Canadian Natural Resources. We do think oil price is going to be well supported at a higher level than before for the many years to come, just because of how OPEC is trying to kind of control, provide floor in terms of the oil price. And this company in itself, even though the sector, the energy sector to us is quite low quality. So hence we only have one company that is Canadian Natural Resources. And this company in particular, we would deem the company to be one of the highest quality company within the energy space, if not the highest quality, just because that it has one of the longest life reserve, which is about 40 years. And at the same time, a very low cost of production per barrel of oil, which is about $30. So then what it means is comparing to a traditional oil and gas company with a life reserve of about 10 years, a lot of the cash flow that they generate on the back of a high level of oil price would get returned back to shareholders through buybacks and dividends. And we have seen that the shares actually did very well in 2023 following our purchase. At the same time, even this year has done very well for us. So this is something quite new to us that we wouldn't have considered it 7 years ago. The other one, which if you have not followed it, is we also have a holding in Charles Schwab, that we would think the company would benefit with interest rates staying higher for longer. Last year, the company didn't do too well because of the regional banking crisis. We actually kept our conviction level. We have invested more when the share was getting hit in Q2 last year. And of course, if you follow the share price recently, that it started to recover quite strongly on the back of this thesis. So we would think that interest rates staying high for longer would be beneficial to the likes of Charles Schwab. And some names that might be apparent to you or not familiar to you in terms of the thesis would be Mastercard and Visa. I'm sure everyone would follow them. But then why would we be calling them the new regime beneficiaries rather than, let's say, maybe comparing to 7 years ago, we'll probably maybe group them under digital transformation in terms of the transition from cash to contactless to more payment in a digital world, which they make a lot of money at the same time travel as well. It's because that Mastercard and Visa, these two payment networks, they charge us a fee on our nominal spending, right? So if you go to a supermarket, let's say at the time inflation was at 10%, they basically charge a fee on that 10% inflation. If today in the UK the inflation is about 4 to 5%, then they would see that as a tailwind. So compare the inflation number, let's say the 10-year period running into the pandemic. I mean, the developed market was about probably between 1 to 2%. What we expect to come in the future, the inflation number is probably going to average between 3 to 4%. So what it means is Mastercard and Visa would naturally get a tailwind of a 3 to 4% growth in consumer spending, and at the same time, given the business in itself is very high margin, that they have a lot of operating leverage when they make more money on the back of just simple inflation numbers. So we actually like them. They have done very well last year for us, and so we continue to own these companies. And then within the artificial intelligence bucket, I don't know how much time I have. I'm happy to take some question on that. I think the one thing that you might want to remember if there's one point I want you to remember is GPU, which Nvidia maintain a very large market share within the pie. GPU in itself, which is not what you find on your laptop or PC, that is a CPU, so GPU, is the computing source of generative AI. So everything that you see today, whether it was ChatGPT, Midjourney, Perplexity, Google Bard or Google Gemini, what they call it now, Adobe Firefly, and any AI applications, that would require a lot of GPU computing power. Without GPU, if everything is being run on the CPU, that is no generative AI, because it might take them a couple of hours before they come back with a response, and no one is going to use it. So any investment that you're seeing or any company is coming out with an application, including even Microsoft launching Office 365 Copilot, they need to invest a lot of money into the GPU space. And of course, in today's context so far, Nvidia maintain a very large market share, which we will expect that to continue in the near future. So the GPU market is exploding, and Nvidia would continue to maintain a large market share. Maybe not as high as today, but still would be high enough to make a lot of money for shareholders. And our view is probably a matter of time before Nvidia would become the biggest company in the world, surpassing both Apple and Microsoft, which is only a few $100 billion to go in terms of market cap. So that is why we still like Nvidia, and we are still maintaining our very big position in Nvidia, despite the fact that it's done very well for us. And then some other names, of course, they equally would benefit from generative AI, just not as much as Nvidia. That's why Nvidia is now the third biggest company in the world, would be the likes of Microsoft or Meta. Meta is a company that we really like. If you haven't followed the fund, we made a lot of money from Meta when we first started in the first few years of the fund. And in January 2022, we actually exited our holdings in Meta because we didn't like where the company was heading. Zuckerberg decided to change the name from Facebook to Meta in Q4 2021. And then there were some concerns about the TikTok competition and also the changes to iOS that in terms of the privacy settings, etc. So we actually exited the company in January 2022. But then when we came back, and then the share price actually went down a lot in 2022, if you follow the story. And then in 2023, when we started to do a lot more work on artificial intelligence on the back of Nvidia, Microsoft, and some others, of course, Meta then came back to the radar. And then we did a lot of work on Meta at the time. And then we decided that Meta is actually going to get a lot of benefit from generative AI in terms of personalized advertisement, which we are going to get in time. So we initiated our position in Q4 last year in 2023, and then we ended up building a very large position quite quickly, just because we have followed the company quite closely before we started building the position last year. And so hence, I think over the last 6 months or so, despite the fact that, recently the share price have gone down probably 15 to 20%, but then we still have delivered a lot of performance on the back of that. We continue to like it. We have no concern about Zuckerberg spending more money. I think it's probably a bit more of a track record issue that investors are slightly concerned that whether Zuckerberg is going to do a repeat of the metaverse spending, which we are not a fan of, and we don't think he's doing that. But of course, I think there's some speculation that maybe people don't believe him enough. So for us, we have no concern of that. So we still think Meta is going to deliver this personalized advertisement to us with all the spending into the GPU market. And at the same time, I probably wouldn't have time to expand too much, but if you're interested, I'm happy to take that over the Q&A, is we also have some selective opportunities within the fund, such as the luxury brands in Moncler, biologics in Sartorius, and gaming or content in Nintendo, and then some others, so they don't feed into the typical bucket, which is artificial intelligence or the new regime beneficiaries. So the last point I will make on this is we are actually very cautious and concerned about the world, the outlook in terms of where the economy is heading. If interest rate continues to stay at a very high level, which is our base case scenario, if geopolitical uncertainty is going to remain, which we think this is the new regime, we're going to see a lot more of this. That is very difficult to find high quality businesses that can actually do well in this sort of environment. Because if you think about in a developed market, 2/3 of the GDP is linked to consumer spending in general. And of course, there are many more companies to make money on the back of that consumer spending trend, whether it's discretionary spending or some others. That going forward, if interest rates are going to stay higher for longer, at the same time, inflation can remain sticky, our discretionary disposable income, discretionary spending is going to remain under pressure. As time goes on, we will need to remortgage, more money is going to suck out from our wallets, and then we end up to be very selective of what else can we actually spend. How can we spend the kind of the leftover that we have after funding everything that's required. So the longer this drags on, is increasingly becoming a lot more difficult for companies which are consumer facing, whether you are technology power company or you are just a traditional consumer facing businesses. And that is a big part of the market which we are avoiding at the moment. And at the same time, going back to the composition of the fund on this slide, is while if you ask me, the one thing that I really want to invest into is artificial intelligence, but unfortunately is in terms of opportunity set within artificial intelligence is very limited. So comparing the opportunity within artificial intelligence to digital transformations 7 years ago is a lot more, the winners or the winners takes all kind of mentality is a lot more limited. So there's only one Nvidia, and we have got enough, and we are constrained that we cannot go above 10% and all that stuff. And so then within that bucket, it's only a quarter of the fund that are exposed to artificial intelligence compared to when we first launched the fund. Digital transformation would probably accounted for maybe 50% of the fund, which then we ended up doing quite well. So it's just one of those things, like it's a new regime. A lot of companies that we used to like currently, like we have different concerns about where they're heading, so that we are not investing in the same type of company compared to before. And then we recognize that certain companies that we didn't need to invest into, and now would be the time to go into. So maybe I will stop here and see whether there's some questions.
Okay, Stephen, let me thank you very much. That is very interesting. You have your own unique perspective on the stock market, would you say?
I have a very unique view about the companies that we owned, and I think this is one of those interesting debates which we constantly get asked about from our investors. Is like, oh, are we bullish or bearish about the equity market? Like, should we like increase equity exposure through the S&P or maybe the UK stock market and all the stuff? I think currently, if you ask me, it does play into the strength of a bottom-up high conviction stock pickers, because we only need to pick about 30 companies globally, and I'm not forced to cover like 100 companies, because I probably would struggle to come up with 100 companies that can actually do what we just discussed. But if you ask me, oh, are we positive about the US stock market? I'm not entirely sure, because I think a lot of names, if you look at the S&P 500 index on an equal weighted basis rather than market cap weighted basis, that it has actually not done well, right? The market cap weighted index has done very well because of the big tech, because of some of the names that we just talked about. But a majority of companies under this new regime are facing a lot of headwinds. So I think the view that we took is a very unique view that we took is the companies that we have in the fund that we think they can continue to do well. But I probably are quite cautious about equity market in general, as in like any companies. I just don't think, unless interest rate does go back down to 2%, then of course you can make money from almost any equity within the market domain. But if that's not the case, it's just more headwind than tailwind for most companies, which is the stock market, isn't it?
But you've got almost 9%, 8.75% of your portfolio is held in Nvidia, who make high quality processing chips. I mean, is there any degree of downside, any degree of risk in holding so much of your portfolio in Nvidia, or are you completely sold on the fact that the AI trend, that it is the main beneficiary and it will become the world's largest company, as you foretold.
Yeah.
Yeah,
Yeah,
that was
thank you for
a
that.
brave
So
call, by the way.
yeah, so thank you for that. So firstly, this is a UCITS constraint strategy, so we cannot actually go above 10%. So 10% is the absolute limit. And if I just take you through very quickly about the journey, without going into too much details, was that we had about probably over 7% position in Q2 last year in 2023, before Nvidia had the single day move of with the share price going up 25%. And of course, within a few weeks of that, in June last year, Nvidia's market cap surpassed $1 trillion. Our view at the time was we had a lot more evidence or data about the applications of generative AI, which we didn't have when we started investing in Nvidia back in 2021. So we actually like it more. And at the time, a lot of people were asking us, oh, many congratulations, you guys have done very well. Nvidia's recovered very strongly as now a $1 trillion company. Are you going to take profit? And of course, with that rise in share price, the 25% increase, then it brought our position from over 7% to just short of 10%. And of course, I mean, now a lot of people would probably regret it, reducing the position in Nvidia, which we did not. And then our response at the time was like, we just started a journey. So basically what happened was we managed to maintain our 10% position, very close to 10%. When Nvidia, the journey between Nvidia surpassing $1 trillion to over $2 trillion today. And we had been a forced seller. So we have been forced to take profits because we can't go above 10%, and Nvidia just doubled in the last 9 months or so. But we still like it. What we are saying today is there's no doubt based on how we understood Nvidia, is going to become the biggest company in the world. It's a matter of time. Okay, is it going to happen in the second half of this year? It's unlikely. And then is it going to happen in the next couple of years? I think it's quite likely. But then the question is, let's say if I'm using Microsoft as a proxy, being the biggest company in the world in absolute dollars terms, that Nvidia only need to go up another 40% from here to become the biggest company. And if we can make 40 to 50% in 6 months or a year, okay, we definitely want to keep the position sizing that we have. But let's imagine that maybe it's not as smooth as it is. Maybe it would take 3 years for Nvidia to become the biggest company in the world. And then if we only going to make 50% in 3 years, which is about 15% a year, then we probably would have other opportunity that can deliver that sort of return, if not higher. So then the question from an investment manager perspective is like, we want to optimize the performance of the fund. Not that we have a different view about the prospect of Nvidia. It's just how much more money you can make from Nvidia after it's become the third biggest company in the world. So that is an internal debate that we're having almost every single day. I think at the moment we still like it a lot, but ultimately, do you need to have a 9% position or can you have a 5% position? I think it's probably with passage of time, we're probably going to have like a 5 to 6% position rather than a 9% position, because we would have other opportunities that we think that can deliver even better return for investors from here. Okay. So that is our take on Nvidia.
Okay, Stephen, let me ask you about semiconductor companies like LamResearch. You hold LamResearch at the moment. They tend to be quite cyclical. So, which doesn't sound like one of your high quality companies. Why hold them? Why hold Lam and other semiconductor companies?
Yes, no, thank you. This is a very important one. So I actually put them down under new regime beneficiaries in terms of, so the two holdings that we have on our top 10 are LamResearch and Applied Materials. So basically what happened, you're completely right. I think this is in the memory of many investors that traditionally the semiconductor equipment sector is very cyclical because the end market is consumers, right? The end market for semiconductors would be PCs, smartphone, autos, and some others. And I just talk about that we are very concerned about consumer spending. Like how on earth would you want to invest into these companies that are exposed to the end market that we dislike about? Okay, something have changed, which is a very important one. So long time ago, that is all true, but since 2022, something have changed completely. What has changed is the geopolitical uncertainties. As we all know, currently Taiwan control over 90% of the high-end semiconductors production, right, through a company called TSMC. And as we all know, the geopolitical outlook or kind of the landscape in Asia Pacific is quite uncertain. I think a lot of people are concerned about it. Hopefully there's nothing going to happen, but that uncertainty would remain with us for many years to come. So what if one day that Taiwan is no longer autonomous region or maybe falls under the control of China, then maybe become like a Russia Europe situation that, oh, if you're friends, we're going to give you some semiconductors. If you're not friends, then you do not have any semiconductors. And at the same time, as we all know, Apple have all their chips made in Taiwan. Nvidia has all their GPU made in Taiwan. So our AMD CPU and all that stuff. So we would be in trouble if we do not have access to semiconductors. So technological advancement will just come to a halt. Like we just stop advancing. Like whatever the GPT-4 that we have, that is it. Like if we don't have the new GPU coming to us in the coming years, then there's no further development because we're constrained by the computing power of silicons. But of course, the Western government had recognized that. So basically, what happened in 2022, the US had the CHIPS Act of giving $50 billion of tax subsidies to incentivize companies to build new foundries in the US. And at the same time, in European Union, they also have a similar number, which is 50 billion euros of tax subsidies to incentivize companies to build foundries in Europe. So in total, there are over $100 billion worth of tax subsidies to incentivize new foundries to be built in the Western countries. And if you look at the numbers today, which is commitment in terms of the dollars terms, there are over $300 to $400 billion worth of commitments to build new foundries in the US, many states in the US, in Germany, in France, and Intel just announced they're going to build a new foundry in Ireland, and then in Japan, in South Korea, anywhere outside of Taiwan, as far as the tax subsidy is concerned. So that if you're selling the mission critical equipments into the foundry, like Applied Material, LamResearch, we used to own ASML. We exited last year just on valuation ground, but the dynamics will be similar. Then they ended up selling many more of the equipments into the new foundries with the government backing, with everyone trying to de-risk away from Taiwan. So basically what it means is the geopolitical uncertainty have given the semiconductor sector a very big tailwind, and this tailwind is going to outweigh the end market headwind in the next coming years, which is unusual. Like we never have this before, because like if we haven't got these geopolitical uncertainties, then you want to avoid this sector at all costs. And I think if you look at the performance of this sector since last year, that it is now behaving not so much like the concern that we talk about consumer spending and all the stuff. It's about the new foundries being built and the certainty of how many more equipments they're going to sell into this new foundries. And that's probably going to get accelerated as well as the geopolitical uncertainty in Asia-Pac continues.
Stephen, you're a star. That was Stephen Yu. He is the lead fund manager at Blue Whale Growth Fund, and that was sparkling. What a great start to the evening. Thank you so much.